Home ownership.
Home ownership. Home sweet home.
Homes, sweet homes. I was thinking about this the other day. I bought 1, 2, 3, 4, 5, 6, 7, 8 homes in my lifetime.
Wow.
Yeah.
That's awesome.
Yeah.
I bought 0. I purchased 0.
You are well on your way, man.
Wow, 8 homes, that's a big deal.
Yeah.
So you've got some experience in, what you should know when you're purchasing a home.
I do.
Okay.
I do indeed. In fact, back in 2005, got into the mortgage business and learned a great deal about the ins and outs and all the granular stuff you need to know about mortgages. So today's show, we're going to talk about what are the 3 main things you need to know when you go out and purchase your home. These are the 3 things that typically are the biggest question marks for people as they start the search process.
Ah, cool.
Yeah.
Okay. So let's start with number 1. What's the first one that you want to tackle?
Well, the very first one, and this is sort of key to actually even getting qualified for a loan, is knowing what your credit score is.
Okay.
So we've done a show on credit score and how to improve your credit score. But essentially what you need to know is, are you at a certain level of your credit score that would allow you to qualify for an FHA or a conventional loan? Okay. FHA is a federal housing administration loan.
Okay.
And a conventional loan would be one where you would put 20% down on a mortgage.
And a federal, you said Federal Housing Administration.
Yep.
So I'm assuming it's different from the conventional. Conventional is 20%. FHA would be
3.5% down.
Okay.
There are some differences in the programs and the products, which I would encourage explorers to go check with a lending agent or a loan officer at a bank or credit union about, or a mortgage broker for that matter. But that actually is number 2. So number 1 is credit score.
Okay.
What's going to qualify you for one of these programs or another. Generally speaking, you need to be around the 620 or 640 and higher in order to qualify for a mortgage.
Okay.
And ideally, you want to be well above 700 to get the lowest possible interest rate. Okay. So the first thing you need to know is your credit score. Second thing you need to know is, what is the down payment that you can afford?
That would probably be a good idea to know.
It would be really important.
Yeah.
Really important. So let's take where you're from.
Okay.
So in LA,
Yep.
if you were to go out and you were to buy a home in, give me a city or a
Arcadia.
Okay.
Pasadena.
Yeah. Okay. So you're in Pasadena, you want to be on the parade route,
Ooh.
and you're going to buy a home there.
Yeah.
What is the sticker price? What's the price tag?
Minimum $1 million.
Is it really?
Yeah, minimum $1 million.
Okay.
And particularly on like Colorado Boulevard or
Yeah.
Parade. Yeah. I mean, these houses are massive.
Are they big?
Yeah.
Okay.
Yeah. In Pasadena, especially like South Pasadena, Old Town Pasadena, very, very, very wealthy neighborhood.
Okay.
Yeah.
So let's take $1 million. Now, some of this is not actually going to work because that would be like a jumbo loan. So it wouldn't exactly comply, but we'll assume that it does.
Okay.
Based on these numbers, if you needed 20% down, I'm going to challenge your math skills. If you needed 20% down on $1 million, that's how much?
$200,000.
$200,000. Good job. Okay, so $200,000 is what you would put down on a conventional loan to go in and buy this house. Okay. You'd probably have a score of whatever, 680, 700 in order to get that. Okay.
Okay.
But if your score was a little bit lower, and you didn't have $200,000, you decided to go for an FHA loan. This would be a jumbo, so it might be a little bit different.
Okay.
But an FHA loan would require 3.5% down. So 3.5% of $1 million is how much?
You're tricking me with the numbers here, but it would be it's not 35,000.
It is, yeah.
That's 3.5% of $1 million. $35,000.
So you would need $35,000 to put down on this $1 million property.
So what's the catch?
Well, in an FHA loan, you're going to have a little bit higher interest rate.
Got it.
There is something called PMI, or private mortgage insurance. And the PMI is an additional cost over and above your traditional principal and interest payment. And essentially what it's doing is it is an insurance policy guaranteeing that if you go south on your loan, that insurance policy kicks in and covers anything that the bank might lose.
Got it.
Right?
Okay.
Or the lender might lose on that. So you need to know your down payment So if we bring this down to a more micro level,
Yeah.
a $200,000 property, if you needed 3.5% down, how much would you have down?
$6,500.
$7,000. Yeah, you're very close.
Oh, you said 6.5, right?
No, 3.5 on 200,000.
Oh. It's 7,000. No,
Yes. It's okay. He was a finance major.
Yeah.
So you need $7,000 for 3.5% down, or $40,000 for
Yep.
20% down, right? So you need to know what your down payment ability is, whether it's 3.5 or 20, and you could do 5% or 10% down, 15%. There's lots of different ways to do that.
Yep.
The key is the money really needs to be yours. So there are ways that it can be gifted to you. It can be gifted by a family or friend, or a family member, I should say. Or if the money is put in your account, it has to be sourced and seasoned, meaning the lender needs to know where it came from, and it has to have been in your account for at least 60 days.
Gotcha.
Okay. So down payment is a big deal. A lot of people say, I'm going to buy this house. Somebody gave me the money to do it. That may fall apart because the lender will say, no, we don't know where this money came from.
Yeah.
So really knowing how much money you have, where it's coming from, and how much you'll need as down payment, essential. That's number 2.
Got it.
Okay?
Clear.
Okay, number 3. Something called your debt to income ratio.
Debt to income ratio.
Yes. So when you hear debt to income ratio, what do you assume that means?
I'm assuming the amount of debt that I have compared to my income. So meaning, like, am I, for my income for a year, is that equal to the amount of debt that I have, or is it half of it, or a third of it? And I'm assuming that the ratio will impact what you're able to not only get like an interest rate on, or sorry, not yet interest rate, but also like loan amount.
Right. Yes.
Because you don't want to take on more debt if you have a massive debt to tiny income.
Correct. So essentially, lenders have said, we want to make sure that someone's debt payments on a monthly basis is less than a certain amount of their overall income on a monthly basis.
Okay.
So debt to income ratios generally are calculated on monthly amounts.
Oh, okay.
So if you have $5,000 in income and you have, I'm not going to give you a math problem, I promise, and you have a $2,500 a month in expenses, and I'm talking about debt payment expenses, car payment, student loan payment, credit card payment, etc., then all of those debt payments plus your mortgage creates a debt to income ratio that has to be lower than a certain amount, and generally that's like 48%.
Gotcha. So just shy of half.
Yeah, just shy of half. In some cases, you can get approved up to and above that amount. It could be up to 52 or 55%. But in reality, what's happening there is you're probably buying more house than you can afford, right?
Yep.
So knowing your debt to income ratio is critical. The way you calculate that is, what is your take home pay? What are all the monthly amounts that you're obligated to pay on your credit report? And then dividing that, right? Dividing one into the other.
So it's not and it's specifically debt payments, not necessarily groceries or gas or anything.
None of that's taken into account.
It's debt.
Strictly debt to income.
Got it.
Yep.
Clear.
So any expenses that don't show up on your credit report would not be included in your debt to income. Any that do, those are included. And for those of you with student loans, this is where it becomes really tricky, because you may be in deferment or forbearance and you think, well, I don't have to make a payment, so it's not there. But the payment actually is calculated in your DTI.
Got it.
Yep. So knowing what your full-blown student loan payment is going to be helpful in calculating what that debt to income ratio is.
Got it.
The reality is you can go to any lender or mortgage person, they'll calculate it for you, but it's really good to know what that is, because the DTI will eventually tell you, okay, you can buy a $150 or $200 or $500 or $1 million home based on whatever you're able to afford DTI wise.
Got it. Very cool. Okay. So there's the 3 things that we need to know in purchasing a home.
Yes.
That's a lot.
That is a lot.
Yeah.
I might add a half.
You might add a half? 3.5?
3.5.
Okay, sure. What's another thing?
So the half, and this happens a lot, and I saw it happen all the time when I was in the mortgage business. Someone would buy a house, they would get into the house in the first month or 2, and something would happen. Furnace goes out, the basement floods, they realize they need a new roof, They furnish it, need to furnish it.
Mm-hmm.
And what they didn't realize is that there were a lot of extra expenses on the back end of owning the home. So what I encourage people to do is not only have your down payment, but also have this reserve account for emergency expenses within the home. And generally speaking, it's going to be 1 or 2 months worth of mortgage payments sitting in a side account waiting to be used.
Got it.
Yep.
So lots of planning that happens.
There's a lot of planning.
Lots of planning. Okay.
There's
Thanks for
a lot of
sharing
planning.
all
Yeah.
these tips.
Well, and I'll tell you one last thing.
Yeah.
It can be a process that is fraught with frustration because it's very long. There's a lot of people that touch the process along the way, and things can get tripped up. But don't worry, things usually work out the way they're supposed to.
Cool.
Right?
Awesome.
Yes.
Good to know, because I know it's the largest purchase most people make in their entire life.
It is.
Yeah.
It's stressful.
Yeah. Can be.
And awesome.
Yeah.
And awesome.
Yeah.
Yeah.
Very cool.
Times 8.
Awesome. Times 8.
Times 8. Yeah.
Awesome. Cool. All right. So our challenge to you is to really factor in all of these 3 things. So just to sum it up, the 3 things to know when purchasing a home is 1, your credit score, 2, your down payment, how much you can, put down, and then 3, your debt to income ratio. There are a lot of different mortgage calculators, and we'll include one in the notes here. So our challenge to you is to go to a mortgage calculator and see what your payments are. See how they fluctuate, see what you can afford based on your credit score, based on how much you're putting down, and also based on your debt to income ratio.
Yes. Oh, was that it?
Yeah, well, there's the 0.5, right? And also factor in 1 to 2 months expenses or mortgage payment.
Yes.
Just to
know
make
that
sure
stuff. You got to know that stuff.
Yeah.
Do your homework. Do your research.
Yeah.
Buying a house is awesome. It takes a lot of work and a little bit of study, but I know you're up for it because you're on the path to mastery.
Yeah. And you're listening to us and watching us.
Indeed. We'll see you next time.
Cool.